Corporate Finance Practice Problem using OneNote. Cash flow impact of tax rate change. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're going to be in the icon on the left-hand side in the practice problems in the 1214 cash flow impact of tax rate change tab. Also note when using OneNote, look at the immersive reader tool. Many of our presentations will be mirrored down in the text area. The text area having the same name, same number, transcripts that can be translated into multiple different languages and either listened to or read in them, thereby being a good complement to the presentations. Closing up the icon, information up top, calculation down below. So we're going to be doing a cash flow kind of calculation. Our focus here as we go on to future presentations in this section will be related to making decisions that are going to be impacting the future. One of the components will be doing a cash flow analysis typically, and we want to take into consideration the impact of depreciation. When we're thinking about an investment situation, we often have things that are going to be capital type of assets that will be purchased, equipment, building, and so on and so forth, that from an accounting standpoint, we would put on the books as an asset and then depreciate them over time. Makes perfect sense from an accounting standpoint. From an analysis standpoint and trying to think or project what will be happening into the future, we want to use a cash flow perspective typically to see what our return on investment will be. The depreciation complicating that system because the depreciation represents something that is not necessarily a cash flow item, the depreciation being expensed possibly in a different time period as the cash flow happening. Therefore, we would like to remove the depreciation typically when doing a cash flow analysis. However, the depreciation for taxes could have an impact, and that would result in a cash flow kind of impact, and that's going to be our question here. So as we analyze this, we want to do a calculation similar to what we've seen in the past, but we're going to be focusing in more closely on the impact of the tax rate as we change the tax rate. So now we're going to change, keeping everything else the same, change the tax rate. So let's say our earnings before depreciation is going to be the $1 million. Depreciation is $500,000. The tax rate is 40%. And then we'll have the same scenario down below with the tax rate then changing to 25% and see what the difference will be in our analysis. So we then say, okay, we're going to start off with the earnings before depreciation and taxes before we take into consider both depreciation and taxes, $1 million. We're going to subtract out the depreciation, even though it's not a cash impact item, but an adjusting entry. That gets us to the earnings before taxes of the $500,000, on which we can then calculate the tax rate. And we've got to be careful on, what kind of items are depreciable to tax depreciation versus book depreciation, which we may get into in more depth in the future. But just keep in mind, depreciation in general, if it's deductible for taxes, it's going to have an impact for cash flow based on the tax impact. So now we're going to have the taxes at the $200,000, which of course will be calculated the 500,000 times the 0.4. There's our 200,000. Then we have our earnings after taxes, the 500 minus the 200. Then we're going to add back in our depreciation because the only reason we took it out is because when we're trying to do a cash flow basis is for the tax impact. So now we're going to add it back in. The 300 plus the 500 is going to give us then the 800,000. So now let's do that same kind of analysis, but let's say the tax rate is only 25% just to get a feel for what the impact is with relation to the taxes on our cash flow for this depreciation item. So we'll do the same kind of thing here. We're going to say it starts off with the earnings before taxes, the $1 million. Then we're going to subtract out the depreciation. This was before taxes and depreciation. That's going to give us the 500,000. Now we calculate the tax on the 500,000, but the rate is only 25% this time. So we got the 500,000 times the 0.25. That's going to give us the 125,000. 500,000 minus the 125,000 gives us the 375,000 earnings after taxes. Then we're going to add back the depreciation to get to the cash flow of the 500,000. The 375,000 plus the 500,000 gives us the 875,000. So note what we're looking at here. We're looking at the cash flow, the impact of the cash flow here, looking at the non-depreciation item and looking at the cash flow impact of it due to its tax impact, which again, taxes really kind of make things complicated. And that's going to give us then our difference of a $75,000 basically cash flow difference due to the non-cash item of depreciation because of the cash flow impact. So that just means when we look into the future and we're trying to make the analysis and kind of base our information on a cash flow type of analysis, which is often the case when we're looking at long-term projects, we have to think about also the impact of the taxes, which can complicate the situation. And one of the major factors where we could have a difference in timing is with the depreciation, which could have, of course, an impact when we're trying to present value our cash flows for a project that could last basically into the future or have an impact on multiple years.